Hey friend, Steve here. Today, I'm going to break down 7 assets that I'd put my money into if I wanted to build generational wealth starting today. Now, all of these assets are reliable, a bit boring, but extremely effective when it comes to building wealth that lasts, all without depending on big banks or the stock market. Let's break them down. First, I believe that the #1 wealth building asset in 2025 is not the stock market. It's not real estate. It's not even crypto. You ready for this? 3 letters. You. I heard a quote from Jim Rohn a long time ago, and I still listen to it regularly. He said, to develop an above average income, you need to become an above average person, meaning you need to learn to work harder on yourself than you do on your job. If you develop skills that really allow you to become a master of your craft, you're going to be able to not just survive, but thrive in even a down economy. Here's specifically how you can develop your skills. #1, practice. #2, practice. And #3, practice some more. Have you ever heard repetition is the mother of all skill? It's true. Practice, practice, practice. I'll share a quick story of a time when I did not practice. I was 21 years old, a senior in college. I had a presentation to give in front of the class. 5 to 10 minutes in, I froze, forgot what to say, and I just sat down. That was one of the most embarrassing situations of my life. I wanted to make sure that, or anything even close to that, never happened again. So fast forwarding to today, what I make it a point to do every time I have a presentation in front of any size group is practice, practice, practice. Personally, I'll practice between 4 to 6 times before I deliver a presentation. And if it's a longer presentation or a presentation given to a large group or people who are very high net worth, I'll practice even more. Earlier this year, we had an event out in Chicago in front of a group of some very high net worth people. There was one group that had a real estate portfolio larger than $1 billion, and I wanted to make sure that my presentation was as good as I could possibly make it, and I wanted that delivery to be perfect. It was a 45-minute presentation. I practiced it 20 times. That was the goal, because I wanted the tone, the pace, the delivery to be as fluent as possible so it was as effective as possible. So I practiced it until I could rehearse it in my sleep. So again, the first place I'd invest in would be myself. And what I would do specifically is invest time and money into developing my speaking and teaching skills. That is key today, and people will seek you out. All right, the second thing that I would do to build wealth in 2025, start a business. So when I think of my clients who have the highest net worth, those that have net worths greater than 10 million, 50 million, and even $100 million, all of them own a business. Some still own it, some have sold it, but they created that wealth by owning a company. Now, the different industry, or I should say the industry's range, really doesn't matter in my opinion, the industry that is. But here's where most people go wrong when it comes to starting their own business. They start to make a little bit of money, and then they go out and spend it on something stupid. I was a prime example of this. When things finally started to pick up for me, I went out and bought a 2017 Jaguar R Sport F-Type. Supercharged, just me and my wife driving around in this car. I thought it was so cool. But if I were to go back in time and talk to my younger self, I would slap myself in the back of the head and say, what is wrong with you? Like, that was the dumbest thing I could have done. Why I say that is because I could have used that money for my business, specifically to hire more employees, specifically good employees that could have helped the business grow faster. And I think growing that business, especially in the early years, is the most important thing to do. So when starting a business, here'd be my biggest piece of advice. The best thing you can do with your profits is reinvest them into the business, specifically into people. What I would do if I was starting all over is hire someone, preferably someone that can save me time by taking some of the small tasks that need to be done every single day off of my plate, an assistant. Then what I would do is hire people that help drive revenue and can help me in areas that I'm deficient in. Could be sales, could be marketing, could be operations. For example, at our company, Dara, our director of operations, is extremely organized and has everything in the company buttoned up. That's not my strength. It is hers. So that helps us continue to move at a fast pace. Hire the right people, specifically those who are knowledgeable, willing to learn, and also humble. That's the big one, and it's actually the biggest one for me. When it comes to humility, I will say that I'd rather take a B player who's humble over an A player who's arrogant. Or I would just keep on looking for an A player who's humble. If you hire someone that is arrogant or doesn't get along with you or challenges you over every little thing, like, it's taxing. And a lot of times people just lose their mind and say, hey, I'm done. I don't want to deal with this anymore. If you want to start your own business to create generational wealth, here is the best piece of advice I can give. Be patient. So important. So I'll share a story about my early years. This might make you laugh. When I first got into the insurance space, first year, how much money do you think I made? Don't laugh. $5,500 gross before tax for the year. The second year wasn't that much better. Made a grand total of $8,000. The third year, you think it got better? Not really. Fourth year, finally, things started to pick up where my income was $30,000. And the fifth year, cracked 100. And I'll tell you what, like, after that, it started to take off. Like, we scaled with employees and we've been in the 7 figures for a while now. But that, probably year 4 and year 5, year 4 really, was when personally, I felt like I had more money than I've ever had. I would not set the expectation or have the expectation that you're just going to make a ton of money within the first year. It might happen. A lot of times we see this stuff online that makes it look like that's going to occur, but it's rare. I'd be patient, set the expectation that you're going to have to work very hard, deal with a lot of rejection, probably not make any money for several years. And if you're okay with that, then starting your business might be a good idea. Let's move on to number 3, which the rest will be assets that involve you putting money somewhere. If I could only pick one asset that would grow my money safely, is liquid, so I can access it anytime I want, and also will help build tax-free wealth, I'd go with whole life insurance. Now, I do this personally. I'm also biased here because this is my background and I do know the product well, because it's what our business offers. And before I got into business for myself, in between the 3rd and 4th year, I worked at an executive benefits planning firm. When I was working at that executive benefits planning firm, we were setting up policies for a construction company, and the owner of that company, I remember what he said to the owner of the firm that I worked at. He said, you know, when we're looking at whole life insurance for the company, I've got about 8 policies myself. And when I look at my life insurance policies and compare the cash value growth to my stocks, bonds, real estate, all of my investments, my life insurance policies have been my best performing asset. Why he said that is because the prior year, for just one of his policies, that was about 30 years old, he paid a $12,000 premium. The cash value grew by about $40,000 that year, just because of the compounding. So he saw that, and he loved the fact that in any economy, this was in 2012, so not too long after 2008, in any economy, his money just kept on increasing over time. So when I look at him, wealthy families, corporations, and even the bank that we work with, they're usually interested in cash value life insurance for one or all of the following points. First, their money grows safely. When we look at a whole life insurance policy that is truly designed for maximum cash value, it typically grows somewhere between 4 to 5% annually, and that's without any risk at all. Second, it's tax-free. As long as we follow IRS rules and your agent does everything right, it's very easy to access that cash value tax-free. Third, you can access your cash value anytime you'd like, and if you borrow against it, it works a lot like your own personal line of credit or your own bank. What this means is that when you borrow against it, you keep earning that 4 to 5% on any money that you've borrowed and what is still remaining in cash value. And the fourth point, generational wealth. When I look at wealthy families that I've worked with for years, typically how they set up their life insurance policies is in a manner where they are very cash rich. They want to be able to access the cash value, but they also want that death benefit that's paid income tax free to be paid to the next generation, the following generation, and so on and so on. So usually what we see most families do is set up a policy where it's either owned by the trust or a trust is the beneficiary. So when someone dies, that life insurance payout is paid to the trust. It gets a big old pile of cash that's income tax free, and then that money is dispersed to the family members, or it stays in the trust, and the trust states exactly how the family can use the money if they want to. Here's the big thing. If you want to get the right life insurance policy, because this is key, there's a couple steps here. So let's just do this. We'll call it whole life. There's two main things. One, company selection. All I'm going to do here is put Big Four. Regardless of who you work with on a whole life insurance policy, I would always look at one of the four major mutual companies, who are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. We've seen them consistently deliver the highest returns on cash value and death benefit to policyholders over time. And in addition to that, they also pay the lowest commissions to agents. The second thing that's the most important, and a lot of times people get confused with this, is the cash value should be prioritized. We'll just call it the design. You can also just say what to look for. First year, here's exactly what I'd look for. Whatever you pay into the policy, your first year cash value should be somewhere between 80 and 90% of whatever you pay. If it's not, that means more of the money is going toward the insurance premium and paying the agent a higher commission. That's just how it works. So I'd question that a lot. That's what I look for, though, just to ensure you can get the best possible policy. So when you look at whole life insurance, it's been used by wealthy families and corporations for a long time. The key is just making sure that it is set up in your best interest, not the agent's. All right, asset number 4. Everybody knows what this one is. Money in the bank, cash. Now, to be clear here, we're talking about creating generational wealth. That's not gonna build generational wealth for you, but it's what everybody looks at. So storing cash in the bank is not a strategy to try and get the highest interest rate that the bank's paying you. Like, that's not gonna do anything. When you look at interest rates in banks compared to everything else, it's not smart to store a ton of cash there. However, why I like cash in the bank is because it helps people make smarter and faster decisions, specifically with less stress. Example. If I'm looking at making an investment, but I don't have cash in the bank, meaning I don't have a buffer there, or I don't have cash flow coming in, I'm gonna be stressed out about draining my checking and savings to make that investment. If I have that buffer there in cash, I have a lot more confidence in making that investment, even if things go south, because I can fall back on it. So what I like to do here is make sure that I've got a buffer. Now, the buffer is different for everyone. You probably heard have an emergency fund of at least 3 months of expenses. That works for some people. For others, it's 12 months. Some prefer to have a certain dollar amount, whether it's 100 grand, some say I want $500,000 there at all times. Everyone's different. Whatever makes you comfortable and helps alleviate that stress, meaning you're not looking at your account saying, oh, I don't have enough there, I gotta try and build it back up, because now all of a sudden your focus is taken away from trying to build wealth and you're looking at your bank balances instead. So what I would do is figure out the number, specifically what number makes you comfortable in terms of having cash in the bank. Once you've got that there, now you can divert your attention elsewhere. All right, asset number 5. This is a good one that a lot of people like, real estate. So I'll say that I do own real estate personally, and I do like it, but it is not my main wealth building vehicle. The real estate I own does cash flow, meaning it produces cash flow that's greater than the expenses and taxes I have to pay on it. But there's some things I don't like about it. So what I own is some commercial real estate, specifically 2 buildings that house the 2 offices for my main company. I've got 3 warehouses that are really warehouse and garage space. One's a storage unit that we rent to small businesses, an office building for a small real estate company, and then also a 2-story home that has a tenant that's a residential lot. But it's all in the same commercial property. Might sound good, but there's definitely some drawbacks and a lot of expenses that come with it. Got to deal with maintenance all the time. Taxes always find a way to continue to go up. Repairs, renovations, tenant complaints have occurred over the years, all of which amount to a lot of money, but more importantly, takes a lot of my time away. Now, the advantage is that it cash flows. The value appreciates. So if I want to sell it, it's worth a lot more than what I bought it for. And I've also been able to use the equity, specifically getting a line of credit for renovations on the property, I could also use that line of credit for my main business if I'd like. So while real estate does have a lot of advantages, why I decided not to expand into it was mainly because I did not want to have it break my focus from my main business. My main business generates a lot more cash, it's more profitable, but that's not the main reason why I do it. It's more fun. My main business compared to real estate. That's why I continue to invest in my main business and not divert some of my attention and focus into real estate. Now, the real estate is great when I look at the income that it produces and again, how it's appreciated over the years, the tax advantages, but the management headaches and dealing with people, that's what I don't like. So I say that to lead into this point. If you're looking to get involved in real estate to build generational wealth, what I would do is not just jump into it and listen to the first mentor that you find locally. I would study the big players, see what they're doing now, see where they've lost money, see how close they were to failing, and then decide if that's still the route you want to go. It's going to take time, it's going to take money, just like any business does. What drives me nuts, and I don't really believe at all, is all of these passive income myths where you can just get into real estate for free and free money. It's like, no, that's not how it works. And if it does for some people, fantastic, but I don't really believe that. It's going to take time and effort if you want to create generational wealth with real estate, just like starting a business. Okay, asset number 6. Here's a good one that everybody knows it works, but you gotta have the stomach for it. Stock market. This is proven to work, but I found that it works best for those who do not get emotionally involved. I've worked with clients who have millions of dollars in the market, and a lot of them have made a lot of money. But at the same time, some have lost money, and they've expressed also how they've lost a ton of time and they're always looking at their account balances. That's the biggest problem I see, that it takes people's time away. They're sitting there nonstop, checking their phones. Is my balance going up, going down? No, I'm gonna sell today because things are rocky. It's like, again, if you're focusing on other areas, whether it's your job, a business, whatever it might be, if your attention is broken from that, you're not going to be as productive as you could be. Now, the stock market, I know that it does work long-term, but if I were to do it personally, it would have to be a situation where I can detach emotionally. Meaning, if I put money in the market, that would be money that I am going to tell myself, this money's gone. Like, I don't want to look at it at all because just by personality, I know I'm going to want to check it all the time. So again, I have to be detached from that. And the big thing for me, similar to not going all in with real estate, is I don't want the stock market in this case to take my attention away from the business. So I've got things in my life where my time and attention goes. I've got my relationship with God and my Bible reading, Tara, my lovely wife, my business, and my friends. But if I take on more, like putting money in the market, my attention's going to have to go toward it, and I just don't want to do it. So while I do think that it can build generational wealth, I think you also have to have the stomach for it from an emotional standpoint. And if you're looking to build wealth through investing, here's what I would do. Study the big players, similar to what we talked about with real estate. The big players are who? Look at Warren Buffett. Ray Dalio is another good one. They've been doing this for a very long time. And the thing I like about those guys is they are extremely consistent, no matter what's going on in the economy or stock market. Look for people who are very long-term focused and have demonstrated the ability to emotionally detach themselves. This way they're not selling everything during a down market, which when your emotions get involved, that's what can happen. So our last asset, crypto. If I could spell that today, that's okay, crypto. To make one thing clear, I do not invest in crypto. However, a lot of my clients do, and I understand why. Crypto, in my opinion, is a lot like a high-risk bet, so I treat it just like that. Now, most clients that I work with who invest in crypto usually express they like it because it's a decentralized currency. It's private, and it's outside of government control. That's usually why that type of individual is also attracted to cash value life insurance. Cash value life insurance is a private contract with a lot of protection. The difference is that it's the opposite of crypto. in terms of its risk level. It is just steady, steady, steady as time passes. But when I look at crypto, here's the big problem I've seen happen the most. It's become so popular over the years that the number of scams, fraud situations, and Ponzi schemes has just been absolutely nuts. If you're going to go heavy into crypto, what I think needs to happen is you need to be willing to do the deep research and know that massive volatility is extremely likely. I view it purely as a speculative play, kind of like how we talked about the stock market, where if you can emotionally detach and say, hey, that money's gone. If it works out, great. If not, I'm okay with losing it. That's how I look at it. That's me, at least. So let's recap the 7 assets that I put my money into to build generational wealth. Number 1, you. Number 2, a business. This is where I've seen most of my clients build generational wealth. 3, whole life insurance, mainly because of its safety, liquidity, and tax benefit. 4, cash, not to build wealth, but to build a buffer that gives you a permission slip to lean into the other areas more aggressively. The other areas are number 5, real estate, number 6, the stock market, and number 7, cryptocurrency. I hope you enjoyed this video. Thanks so much for watching all the way through. If you'd like to check out another video that I did on creating generational wealth, you can watch that here.